There are rare moments in financial markets when the surface looks calm, but beneath that calm, something structural is shifting. This is one of those moments. The precious metals market is approaching a temporary vacuum, and most investors have not yet processed what that vacuum could reveal. China, the most influential force in global physical gold and silver demand, is closing its exchanges for the Lunar New Year. For more than a week, the trading activity that has increasingly guided global price direction will pause. And when a dominant participant steps away, the silence itself can become a signal. Today is Friday, 13th of January 2026, and the timing of this pause is not accidental. Gold eased lower in today's session. Silver followed. Gold slipped as much as 0.8% after advancing the previous day. Silver declined 1.8%, trading near 82,081 per ounce. On paper, those moves may appear routine. Markets fluctuate constantly, but what matters is not the percentage change. It is the context surrounding it. Investors are adjusting to the reality that Chinese exchanges, which have played an outsized role in shaping short-term price momentum, are about to close until January 24th. For well over a decade, China has been central to the physical flow of gold. But over the past several years, its influence has expanded far beyond physical consumption. Adrian Ash, director of research at Bullion Vault, summarized this evolution clearly. He noted that while China's dominance in physical gold flows has been established for years, the real transformation came from the surge in speculation and derivatives trading on Chinese exchanges. That speculative and futures-driven activity has grown powerful enough to influence bullion pricing worldwide. In effect, China is not just a buyer. It has become a price setter. That distinction carries weight. Physical demand shapes long-term balances between supply and consumption. Derivatives activity shapes liquidity, volatility, and immediate direction. When the Shanghai Gold Exchange and the Shanghai Futures Exchange close, the market temporarily loses a major engine of price discovery. For more than a week, global participants must operate without that engine running. The question then becomes simple but profound. What happens when the market's center of gravity steps aside? Some argue prices may soften without consistent Chinese demand. Others believe Western traders may attempt to assert control over short-term direction. There is also the possibility that prices simply consolidate within a range, waiting for Chinese participation to return. To evaluate these possibilities honestly, we need to understand what has been happening inside China, particularly in silver. Demand for physical silver within China has been unusually intense. Domestic producers and traders have struggled to clear order backlogs. The system has not been moving metal fast enough to satisfy buyers. Near-delivery futures contracts on the Shanghai Futures Exchange have been trading at meaningful premiums compared to contracts expiring later in the year. Under normal conditions, futures curves reflect carrying costs, such as storage and financing, meaning later contracts typically trade at slight premiums. But when immediate supply becomes scarce, the structure shifts. Front-month contracts command higher prices because buyers value certainty of delivery now rather than promises of delivery later. That inversion signals urgency. Traders are willing to pay more today because they are not confident about availability tomorrow. This dynamic is not theoretical. It reflects tangible stress in the supply chain. The situation grew sufficiently tight that the Shanghai Futures Exchange introduced a rule adjustment. Certain entities holding silver futures for hedging purposes were restricted from carrying those contracts through to physical delivery. In practical terms, the exchange intervened to slow the outflow of silver from its warehouses. Exchanges do not modify delivery rules lightly. Such measures typically indicate that available inventory is under pressure. The decision suggests that supply tightness reached levels significant enough to require administrative action. Now, immediately following that intervention, the exchange is closing for more than a week. It is important to understand that demand does not disappear simply because trading pauses. Lunar New Year is associated with cultural gift-giving, and precious metals often play a role in those traditions. Historically, analysis from Nikki Shields at MKS PAMP has shown that precious metals tend to perform strongly in the 10 days leading into Lunar New Year as buyers accumulate ahead of the holiday. Interestingly, contrary to common assumptions, price support has often persisted during and after the holiday period. Many assume that when Chinese markets close, prices weaken because a major source of demand is absent. Yet historical patterns do not consistently confirm that view. Pre-holiday buying often establishes a foundation that extends through the closure. However, it would be careless to rely solely on historical averages, without recognizing that this year includes unique variables. Silver volatility has reached levels not observed since 1980. Prices recently touched an all-time high on December 29th before retreating significantly. The magnitude of recent swings rivals some of the most dramatic episodes in modern silver history. Gold experienced similar, though less extreme movement. It surged above 5,595 in late December and then fell roughly 13% over 2 days. an extraordinary move for a metal typically associated with stability. Despite that correction, gold has regained approximately half of those losses and now trades above $5,000 per ounce, near $5,350. That recovery suggests that demand remains structurally present. The pullback appears to have relieved speculative excess rather than dismantled the broader trend. Institutional outlooks reinforce this interpretation. BNP Paribas projects gold reaching $6,000 per ounce by year-end. Deutsche Bank and Goldman Sachs maintain constructive views on the metal's trajectory. These projections are not casual opinions. They reflect assessments of macroeconomic drivers that remain largely unchanged. Geopolitical tensions persist. Questions about the independence of central banks, including the Federal Reserve, remain unresolved. Sovereign debt levels across major economies are historically elevated. The gradual shift away from reliance on traditional assets such as currencies and government bonds continues. Christopher Wong of Overseas Chinese Banking Corporation described the current environment as a transition from an acceleration phase to a consolidation-driven regime. In January, momentum fueled rapid gains. Speculative enthusiasm amplified price movements. That acceleration ended with sharp corrections. The market has now entered consolidation, a period where advances, if they occur, are likely to be more measured and dependent on macro validation, rather than momentum alone. Consolidation does not equate to weakness. It represents digestion of prior gains and reassessment of conviction. During this stage, short-term fluctuations can obscure longer-term structural forces. The absence of Chinese trading activity over the next several days will test whether those forces are sufficiently broad to sustain stability without their most influential participant. As the exchanges close and global markets adjust, the silence may prove informative. Whether prices drift, hold firm, or experience renewed volatility, each reaction will offer insight into how deeply integrated Chinese demand has become within the global precious metals ecosystem. As the market settles into this consolidation phase, attention naturally turns toward macroeconomic catalysts that could either reinforce or challenge the broader bullish framework. The most immediate variable on the horizon is the core consumer price inflation report, scheduled for tomorrow. Inflation data carries significant weight because it directly influences expectations surrounding Federal Reserve policy. Precious metals do not yield interest, so their relative attractiveness often depends on the direction of real rates. If inflation moderates more quickly than anticipated, it increases the probability of interest rate cuts. Lower rates reduce the opportunity cost of holding gold and silver, often supporting their prices. If inflation remains elevated, policymakers may hesitate to ease, which could temporarily restrain upside momentum in metals. No analyst can predict the precise inflation figure with certainty. Markets frequently respond more to the gap between expectations and actual results than to the raw number itself. A softer reading than forecast could validate the thesis that monetary conditions will gradually loosen. A stronger reading could trigger short-term volatility as traders reassess rate expectations. In either case, the reaction will reveal how positioned investors already are and how resilient conviction remains following January's turbulence. January's volatility marked a turning point in market psychology. Gold's surge above 5,595 in late December captured attention globally. The subsequent two-day decline of approximately 13% shook confidence and forced participants to reassess risk tolerance. Silver's movement was even more dramatic. After reaching an all-time high on December 29th, it retraced sharply, ultimately settling roughly one-third below that peak. The magnitude of those swings invited comparisons to 1980, a year etched into market history due to extraordinary silver volatility. While today's drivers differ from the Hunt brothers' attempt to corner supply in 1980, the intensity of price fluctuations underscores that the precious metals market is undergoing a meaningful repricing. This repricing is not confined to speculative enthusiasm. It is rooted in macroeconomic stress, elevated sovereign debt levels, and institutional reassessment of monetary stability. The fact that gold has recovered to trade above $5,000 per ounce, near $5,353, suggests that the correction did not invalidate the structural thesis. Instead, it appears to have flushed excessive leverage and restored equilibrium before the next potential phase. Institutional projections reinforce this interpretation. BNP Paribas has outlined a year-end target of $6,000 per ounce for gold. Deutsche Bank and Goldman Sachs maintain constructive outlooks as well. These forecasts are based on analysis of fiscal deficits, geopolitical instability, currency diversification trends, and long-term debt sustainability. They are not momentary reactions to daily headlines. The persistence of these projections following January's volatility indicates that large financial institutions view the recent correction as part of a broader bull cycle rather than its conclusion. The macro backdrop remains complex. Governments across major economies continue operating with substantial deficits. Debt to GDP ratios sit at historically elevated levels. Central banks have expanded balance sheets dramatically over recent years in response to crises. While those actions provided short-term stability, they also altered perceptions about long-term currency reliability. In such an environment, gold's role as a store of value regains prominence. Unlike fiat currencies, gold carries no liability. It exists independent of policy decisions. That attribute becomes increasingly relevant when confidence in traditional instruments wavers. Central bank accumulation reflects this recognition. Multiple countries have expanded gold reserves openly. China, Russia, India, Turkey, and others have added to holdings. Even nations closely integrated into the dollar-based system have pursued diversification. This steady institutional demand provides structural support for gold prices. It creates a baseline bid that often absorbs selling pressure during corrections. Silver, however, lacks that central bank foundation. Its demand profile leans more heavily on industrial use and regional physical consumption. The recent surge in Chinese silver demand, evidenced by order backlogs and elevated near-term futures premiums, effectively served as a stabilizing force. When immediate delivery contracts trade above deferred contracts, it signals urgency in securing supply. That structure emerged because buyers prioritized physical availability over future promises. The Shanghai Futures Exchange's decision to restrict certain hedging participants from carrying futures through delivery further illustrates the strain. Exchanges rarely adjust delivery frameworks unless inventory levels face pressure. By limiting additional warehouse outflows, the exchange sought to maintain orderly functioning. This context makes the upcoming holiday closure particularly significant. A market already managing tight supply will now operate temporarily without its most active participant. Several potential outcomes remain plausible. Reduced Chinese participation could leave global markets thinner, amplifying volatility in either direction. Lower liquidity means fewer orders are required to move prices materially. Alternatively, prices might stabilize within a defined range as participants await reopening and fresh macro signals. It is also possible that Western buyers absorb some of the slack, maintaining balance until Chinese trading resumes. Historical tendencies offer partial guidance. Analysis has shown that precious metals often perform well in the days leading up to Lunar New Year as buyers accumulate ahead of the holiday. Contrary to widespread belief, price support frequently persists during and after the closure. However, historical patterns do not guarantee repetition. This year's volatility, elevated price levels, and supply tightness introduce variables not present in every prior cycle. Investors should resist interpreting short-term movement as definitive evidence of trend reversal. Consolidation phases inherently involve oscillation. Gains become more measured, as Christopher Wong described, and increasingly dependent on macro validation. The acceleration phase driven by momentum has concluded. What remains is a period of evaluation where economic data, policy signals, and structural demand trends guide direction. The inflation report tomorrow may serve as a catalyst. A softer reading could strengthen the narrative of eventual rate cuts, reducing real yields and supporting metals. A hotter reading could delay that narrative, prompting temporary caution. But neither scenario erases underlying debt dynamics or central bank diversification trends. These structural forces operate on longer time horizons. As January 24th approaches and Chinese exchanges prepare to reopen, the market will watch closely. A resurgence of aggressive buying could confirm that demand merely paused during the holiday. Renewed premiums on near-term contracts would suggest that supply tightness persists. If activity returns subdued, it may indicate backlog resolution or temporary saturation. Either outcome provides insight into the sustainability of recent price levels. For now, the precious metals market stands at an intersection of macroeconomic data, institutional forecasts, and regional demand shifts. The coming days will not redefine the structural narrative, but may influence its pace. Observing how prices respond without Chinese participation will reveal the extent to which global dynamics have diversified beyond a single geographic anchor. When you zoom out far enough, what becomes clear is that this moment is not just about 10 days of reduced Chinese trading. It is about the evolution of confidence inside the global financial system. Precious metals are responding to pressures that have been building for years, and those pressures do not pause simply because exchanges close for a holiday. They continue operating quietly beneath the surface, influencing decisions made by central banks, institutional investors, and private holders alike. Gold's structural position in this environment is distinct. It benefits from steady accumulation by central banks seeking diversification away from concentrated currency exposure. When gold declines, official sector buyers often treat weakness as an opportunity. That behavior provides a degree of stability uncommon in other asset classes. The recovery following January's sharp two-day 13% decline illustrates that support. After falling from above $5,595 in late December, gold rebounded and now trades above $5,000 per ounce, near $5,353. That stabilization suggests that underlying demand did not evaporate during the correction. Instead, it absorbed speculative excess and reestablished equilibrium. Silver's behavior is inherently more volatile. Without consistent central bank purchases, it lacks a permanent institutional bid. When selling intensifies, the absence of a structural floor can accelerate declines. Conversely, when buying momentum builds, there are fewer systematic sellers to cap gains. This dynamic explains why silver's rise to an all-time high on December 29th was so dramatic, and why its subsequent retracement, leaving it roughly one-third below that peak, felt equally forceful. Trading near $82.81 per ounce, silver remains elevated by historical standards, even after volatility reminiscent of 1980. Comparisons to 1980 highlight magnitude rather than identical causes. That earlier episode centered on concentrated attempts to corner supply. Today's volatility reflects global macroeconomic adjustments, debt concerns, and evolving reserve strategies. The intensity underscores that the market is repricing risk rather than collapsing under speculation alone. This distinction is critical when evaluating whether consolidation represents weakness or digestion. Institutional forecasts continue to lean bullish. BNP Paribas projecting $6,000 gold by year-end signals confidence in sustained macro tailwinds. Deutsche Bank and Goldman Sachs maintaining constructive outlooks reinforces that perspective. These institutions consider fiscal deficits, geopolitical tension, and long-term debt trajectories in their models. Their continued optimism following January's correction suggests they interpret volatility as transitional rather than terminal. Macroeconomic uncertainty remains elevated. Sovereign debt levels across major economies are historically high. Governments face fiscal pressures that complicate monetary policy decisions. Central banks must balance inflation control with economic stability. Such an environment naturally elevates interest in assets perceived as stores of value. Gold's independence from any single issuer enhances its appeal. Silver's dual role as both monetary and industrial metal introduces additional complexity but also potential leverage to broader economic shifts. China's temporary market closure introduces a test of liquidity and sentiment. The Shanghai Gold Exchange and Shanghai Futures Exchange stepping offline removes a significant source of price discovery until January 24th. During this period, global participants will observe how prices behave without one of their most influential drivers. If gold and silver maintain stability or advance modestly, it suggests diversification of demand beyond a single geographic region. If volatility intensifies, it reinforces the magnitude of China's influence. Importantly, the physical demand conditions that prompted exchange rule changes do not vanish during the holiday. The Shanghai Futures Exchange restricted certain hedging participants from carrying futures to delivery because warehouse inventories were under strain. That administrative intervention reflected tangible supply tightness. Cultural demand associated with Lunar New Year traditions also continues irrespective of trading hours. When exchanges reopen, the market will quickly gauge whether backlogs have intensified or eased. The inflation report due tomorrow adds another layer to this unfolding narrative. A softer than expected reading could increase expectations of Federal Reserve rate cuts, reducing real yields and supporting precious metals. A stronger reading might temporarily dampen enthusiasm by delaying easing assumptions. Yet even in the latter case, the broader themes of debt expansion and reserve diversification persist. Short-term policy adjustments rarely override structural transformations. The shift from acceleration to consolidation described earlier remains a defining characteristic of the present phase. Rapid momentum-driven gains have subsided. What remains is a more measured environment, where progress depends on macro validation. Consolidation challenges conviction precisely because it lacks the emotional clarity of a breakout. It requires patience and disciplined analysis rather than reactionary positioning. For investors, perspective becomes paramount. The volatility experienced in January tested resolve. Those who interpreted the two-day decline as the end of the cycle may have exited prematurely. Those who understood it as part of a broader repricing retained alignment with long-term projections. Consolidation often separates reactive participants from strategic ones. It demands clarity about why an asset is held and what conditions would truly invalidate that rationale. Gold above $5,000 per ounce and silver above $80 per ounce reflect a significant repricing compared to historical norms. These levels would have seemed extraordinary not long ago. That repricing occurred alongside rising debt burdens, central bank diversification, and geopolitical uncertainty. None of those forces have dissipated. Instead, they continue to shape allocation decisions globally. As January 24th approaches, attention will focus on how Chinese traders respond upon returning. Renewed intensity in physical buying or near-term futures premiums would validate concerns about persistent supply tightness. A calmer reopening might suggest temporary saturation or backlog resolution. Either outcome contributes to a clearer understanding of the market's internal balance. The coming days, therefore, represent observation rather than conclusion. Tomorrow's inflation reading, the interim period of reduced Chinese participation, and the eventual reopening each provide incremental data. None alone determine the trajectory of gold towards $6,000 or silver's ability to sustain levels above $80. They are pieces within a broader structural framework. That framework includes institutional forecasts grounded in macro analysis, central bank accumulation patterns, and tangible supply dynamics. It includes volatility levels comparable to historic episodes, yet driven by distinct contemporary factors. It includes a market transitioning from acceleration to consolidation, testing durability rather than momentum. In such an environment, maintaining composure is essential. Short-term fluctuations should be evaluated within the context of structural drivers. Temporary absence of a dominant participant does not erase demand. Administrative rule changes aimed at preserving inventory do not occur in balanced markets. Institutional projections of higher prices are not casual declarations. They reflect assessments of systemic pressures that remain unresolved. As trading continues without Chinese exchanges active, the silence will reveal as much as participation. Stability would demonstrate resilience. Volatility would highlight dependence. Either outcome enhances understanding. When China returns, the market will respond accordingly, integrating accumulated information into the next phase. Ultimately, the precious metals narrative remains one of transition within the global financial architecture. Debt levels, policy uncertainty, and reserve diversification shape long-term trends more profoundly than daily headlines. The consolidation phase is a chapter within that larger story, not its conclusion. Investors who recognize this distinction position themselves not for immediate reaction, but for measured adaptation as structural forces continue unfolding.